According to our Income Tax Act, leasing entities are taxable, and they are taxable at a corporate tax rate prevailing in the year of income, that is 30% tax rate. 30%, that is for resident companies, and non-resident companies 37.5%. Again, we need to know that as far as leasing entities are concerned, there is always a relationship between the two parties, and the party that is acquiring this particular asset, we normally refer to him as the lessor. The lessor is the owner. Or is the leasing entity. Then on the other side, we have the leasing. And the leasing is the person who has taken this particular asset for the purpose of generating the income. So we have a relationship whereby when this lessee took those particular assets, he utilized those particular assets, and the revenue that he generates, he will use that particular amount to pay the lessor. And therefore, when we are taxing the leasing entity, one of their major income is the lease income. Lease income is the income that we are getting now from this particular entity, that is the leasing. Therefore, although you will find that they can also generate other incomes like investment income, foreign exchange gain, and such. And therefore, as far as taxation of leasing entities is concerned, we need to know that the incomes that they are generating, they should be included, and the expenses that they are incurring in the process of generating the taxable income, then such expenses should be deducted. So their major taxable income is lease income that we are receiving from this major taxable income. Will include the lease income. The second major income, taxable income, will be foreign exchange gains, and in most cases we tax it if it is realized. And number 3, investment incomes. However, in order for these incomes to be taxed, we are saying the revenue expenses incurred to generate these incomes, they are supposed to be deducted. So revenue expenses deductible, will include, for instance, we have capital allowances, and capital allowances will arise because the lessor is acquiring the assets, and these assets are subject to loss of value, and therefore that loss of value, or maybe the capital allowance that was granted to encourage investment in that particular asset, like investment deduction, that capital allowance should be calculated and be treated as an allowable expense by the lessor. The other expense that is deductible is administrative costs. These administrative costs are operating costs incurred by the leasing entity. For instance, maybe the general expenses like postage and stationery. We have costs like cost for lunch, we have rent, we have license, we have all that, anything to do with the administration. So that cost should also be treated as allowable cost. Again, in case they incur selling cost, marketing cost, marketing cost. Even such costs are treated as allowable cost. And therefore, when we get this total income, we less this cost. What you get, we refer to it as taxable profit. And this taxable profit should be taxed at a corporate tax rate. Maybe it is 30%, so that now we can get the tax liability tax liability. So simply, learners, that is how we tax the leasing entities. Then we need also to understand how we tax trade associations. Taxation of trade associations. And basically, when we talk about trade association, we refer to those particular associations that are formed by business people for the purpose of promoting their business interest. Remember, traders, especially those traders who are operating similar businesses, most of them, they have common interest. And in order for them to promote their common business interest, they can come together and they form a trade association. And therefore, trade association, according to the Income Tax Act, it claims that such an association is in business and it is liable to pay tax, again, at a corporate tax rate of 30% if it is resident, or 37.5% if it is a non-resident. So trade association, the moment they are formed, especially by traders, then we will claim that they are in business and they are liable to pay tax at a corporate tax rate prevailing in the year of income. That is either 30 or 37.5%. Now, because they are taxable, what are some of their taxable income? For trade association, their taxable incomes will include, for instance, we have entrance fees. Remember, we are talking of members. So the members have to contribute some money so that they can join the association. So that entrance fee that is paid will form one of their major taxable income. The second major taxable income is members' subscriptions. You'll find that these members, after they join the association, then every year or every month they are likely to be making regular contributions or subscriptions. That subscription, again, it is treated as a taxable income. The other taxable income is investment income. So investment income, again, in kind, should also be subjected to tax. For instance, maybe they have constructed houses somewhere and they are getting rental income. Maybe they are doing farming somewhere. Maybe therefore they are getting farming income. So in such cases, such incomes should be subjected to tax. But we do not deduct expenses. So we just capture these particular incomes, we get the total, and we calculate the tax liability. The last part in our area is taxation of members' club.